Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the Chinese economy. If you've been following the channel, you'll know that China has been struggling throughout 2023 and that the forecast GDP for this year has now been revised down to 5% growth, compared with 6.5–7% at the start of this year. And the big question is whether or not China will be able to hit that mark. And some of the data has now been released for October, and it shows that year-on-year exports are surprisingly down. They've come in at 6.4% lower than they were this time last year, which actually represents a worse position than China was in September. And that was a surprise to the markets. Everybody was expecting that we would see an improvement compared to last month. Now, imports have actually improved month on month compared to where they were in September. But when you drill down into the details of that, it doesn't appear that that's reflecting a marked recovery and may just be a 1 month blip. And one of the other things that's really important is what's going on with the purchasing managers. These are the guys who are buying in all of the raw materials and the fuel for their companies in anticipation of how much business they'll be doing over the next few months. And the Purchasing Managers Index has now dropped below the critical 50 mark for the first time in 3 months. So that indicates that Chinese businesses are now contracting. And this comes at a time when China is having major problems with deflation. It's really struggling to get any price increases. And the factory gate price data that we've just seen for October tells us that factory gate prices are down year on year by 2.5%. So what that means is that if you're a company in China, you're selling your finished products today for 2.5% less than you were this time last year. And obviously, to maintain your profit margins, you would need your costs to also be falling by at least 2.5%. And all of this is having a negative impact on the Chinese yuan. But interestingly, over the last month or so, the value of the yuan has remained entirely flat. And there are now concerns that the Chinese authorities are artificially manipulating the price. And interestingly, on Halloween, there was a liquidity crisis in China. So in today's video, I'll have a detailed look at what's happening with exports, imports, the Purchasing Managers Index, inflation, and the Chinese yuan. And then after all of that, I'll go through my summary as to what I think is likely to happen in China over the course of the next 3 to 6 months, and what the implications of that will be for the Chinese economy and also the global economy, because China is the second biggest economy in the world. But before we get started on all of that, once again, I'd like to say thank you so much to everybody that's bought me a coffee or sent me a YouTube super thanks. Really appreciate that, and it helps me to be able to get some new statues in, and you may be able to spot one in the background today. And if you'd like to support the channel, please have a look below where you'll find links to my Patreon page, where you'll find videos that are not being posted on YouTube and also be able to avoid the ads, as well as buy me a coffee and YouTube super thanks and membership scheme. This chart shows the year-on-year percentage movement in China's exports and imports for the last 2 years. The movement in exports is shown by the dark blue line on this chart, and the movement in imports by the light blue line. And the scale on the left-hand side goes from -20% at the bottom to +30% at the top, and 0% growth is shown by the dark black line around 1/3 up the chart. Now, we start off by looking at what's been happening with exports, because exports are vital to China. The Chinese economy has been built on manufacturing, and the revenue that China receives from its exports equates to around 25% of total GDP. And as you can see from this chart, there's been a significant downward trend in the level of China's exports over the last 2 years. And in October 2022, exports actually moved into negative territory, so they started shrinking. And if we look at this chart, which provides a detailed breakdown of what's been happening over the last 12 months, you can see that China has only achieved growth in exports in 2 months in the last year. At the end of 2022 and the start of 2023, there was a significant fall in exports, falling 9% in November, 10% in December, and 12% year on year in January. China then experienced a brief recovery as a result of the removal of the COVID-19 restrictions, and in March of this year actually achieved 11.3% growth year on year. However, that growth reduced to 7.3% in April. In May, exports were down 7.3%, 12.4% in June, and hit a 12-month low in July when exports fell by 14.3%. Now, in the following 2 months, the fall in exports started to improve, falling to 8.7% in August and 6.2% in September. And there were hopes that the outlook for China was looking more positive and that by the end of 2023 China could return to positive growth in exports. However, the figures for October show that exports are down 6.4% year on year, which represents a worse outcome than China recorded in September. And the fact that the recovery in exports now appears to have stalled puts a question mark over whether or not China will be able to achieve its year-end GDP growth target of 5%. A senior economist at the Economist Intelligence Unit said since the global electronics market is on the rise, as affirmed by South Korea and Vietnam's export performance, China's poor export data points to weak demand in other categories such as Christmas goods and garments. The export figures are in contrast to market expectations. The bad export data may hit market confidence as we had expected the supply chain of exports to recover. If we now focus on what's been happening with China's imports, you can see that the year-on-year performance is following a very similar trend to what we just discussed for exports. And the reason that the level of imports is important is that it tells us two things. Firstly, it tells us what Chinese businesses are doing because a lot of companies import raw materials and fuels, which they use in their manufacturing processes. And also it tells us what's happening with domestic demand in China. And if we look at the movement of the light blue line, you can see that the year-on-year performance actually deteriorated quicker than it did for exports. And by March 2022, the level of imports was at 0% growth year on year. Imports remained flat year on year for the next 6 months. However, in October 2022, imports started to decline. And if we look at this chart, which gives us the detailed breakdown on a monthly basis, you can see that China has experienced a year-on-year fall in imports in 10 out of the last 12 months. And in comparison to the figures that we just looked at for exports, some of these figures are much higher, with the year-on-year fall in imports hitting a low of 21% in January of this year. The level of imports briefly moved into positive territory in February. However, they returned to negative territory in every one of the following 7 months. But interestingly, the latest figures for October show that the year-on-year movement in imports is up by 3%. So this positive movement could indicate that China is on the verge of an upswing. However, we need to look into the details as to what China has been importing. China imported 13.5% more crude oil in October, which represented a marginal increase on the September figure, and soybean imports jumped 25% as the surge in cheap and plentiful shipments from Brazil continued. However, the Economist Intelligence Unit said the positive surprise on imports seems to reflect a firming up in domestic demand, rather than deriving from distortions caused by the one-time bulk buying of commodities. And analysts believe that it's too early to say whether recent policy support will be enough to shore up domestic demand, with property, unemployment and weak household and business confidence threatening to undermine a sustainable rebound. This chart shows the Purchasing Managers' Index for both manufacturing and non-manufacturing businesses in China. If you follow the channel, hopefully you'll be familiar with this index, but for anybody that hasn't come across this before, the Purchasing Managers Index is a survey of all of the purchasing managers in China, asking them whether or not their business is expanding or contracting. And the scale on the left-hand side of this chart shows the score as an index, and the critical level is 50. If the score comes in above 50, it indicates that the business is growing. If it's below 50, it tells us that the business is contracting. And if we look at what's been happening with the PMI for manufacturing, which is shown on the red line here, you can see that since the start of 2021, the index has been at or below the critical 50 level, which explains why there are so many concerns over the Chinese economy. Because if the Chinese economy was doing well, then these manufacturing businesses would be recording scores significantly above 50. So the fact that this index has been struggling really documents the problems that Chinese manufacturing has been encountering. And if we look at this chart, which gives us a detailed breakdown of the manufacturing PMI over the last 12 months, you can see that the index has only been recorded as being above 50 in 5 of the last 12 months. And every single time that the index has got above 50, it's fallen in the following month, which tells us that in the last year, there has not been any prolonged or consistent growth, and that the increases in the PMI may have been caused by short-term stimulus injected into the economy by the Chinese authorities. And if we look at the score for October 2023, you can see that it's been recorded at 49.5, which tells us that the majority of manufacturing businesses in China are currently contracting. And if we look at the movement in non-manufacturing PMI, which is shown by the grey line, you can see that the trend is very similar to what we just discussed for manufacturing. However, the movements are far more pronounced. And if we look at the detailed breakdown over the last 12 months, you can see that non-manufacturing PMI hit a high in March of this year. However, since that time, there has been a steady and consistent decline in the PMI, and it is now sitting just above the critical 50 level. Inflation continues to be a major concern in China, and unlike the majority of the rest of the world, which is struggling with high levels of inflation, China's problem is actually the reverse. It's deflation. This chart shows the movement in inflation over the last 12 months, and as you can see, inflation hit a high of 2.1% in January of this year. However, inflation fell rapidly in February and March and was recorded at 0.1% in April, 0.2% in May, 0% in June, moved into negative territory when it was recorded at minus 0.3% in July, recovered to 0.1% growth in August, and was recorded at 0% in September. But one of the biggest concerns for Chinese business is what's happening with the producer price index, which is often referred to as factory gate prices. So this is the price of goods as they leave the factories in China. And as you can see from the blue line in this chart, factory gate prices have been falling consistently over the past 2 years and actually moved into negative territory in October 2022. And if you're a Chinese business, what that means is that you're selling your products today for less than you were selling this time last year. And the only way that businesses will be able to cope with that is if their costs were also reducing at an equivalent rate. But because Chinese businesses have to buy in a lot of raw materials and fuel, their input prices are not falling, and therefore this is having a disastrous impact on Chinese businesses' profit margins. And if we zoom in and have a look at what's been happening on a monthly basis over the last 12 months, you can see that the year-on-year movement in producer prices has been negative in every single one of the last 12 months. And this is why Chinese businesses are now under so much pressure, because their prices are falling year on year, but also the level of exports, as we talked about at the start of the video, is also down. So it's a double whammy from their point of view. Their exports are down and prices are down. And this is a very difficult situation for the Chinese authorities to be able to sort out, and is one of the major reasons why China wants to avoid going into a deflation cycle. This chart shows the movement in the exchange rate between the US dollar and the Chinese yuan over the last 12 months. And what this shows is that between January and August 2023, there was a significant decline in the value of the yuan. On the 13th of January, $1 US was trading for 6.7 Chinese yuan. However, by the middle of August, the rate had dropped to 7.3, which represents a decline of around 8%. And you may be thinking, well, 8%, that's not too bad, that's less than 10%, that shouldn't be anything to write home about. But for a country like China, which is dependent upon exports, it's having a really big knock-on impact to the Chinese economy. And of course, the position with the strength of the currency is a little bit chicken and egg. As we talked about at the start of the video, exports are down around 6.4% year on year. So demand for China's products is falling. So that means generally that demand for the currency also falls. And when demand for your currency falls, obviously the value tends to fall. And the problem for Chinese consumers is that they now have less purchasing power, which ordinarily would drive up inflation in the country. But as we've just discussed, China is currently struggling with low levels of inflation. And this is a very similar situation to what happened in Japan for around 20 years at the start of this century. And one of the concerns now is that the yuan could start to fall in value significantly. And I think it's interesting when you look at the shape of this chart that over the last 2 months, the value of the yuan has remained almost flat. And if you compare that to the significant movements in value over the last 10 months, and also take into account the fact that the dollar has strengthened against most other currencies over the last few months, there is a potential that the Chinese authorities are currently supporting the Chinese yuan to maintain its value and stop it falling any further. And really interestingly, on the last day of October, a liquidity crunch was experienced in the Chinese money markets that resulted in short-term money rates surging to as much as 50%. The overnight rate for the pledged repo, a short-term way of financing business, hit a record high of 50% on the 31st of October as the month-end scramble for cash and a flood of government bond sales caused stress in the Chinese money markets. Traders and analysts said an increasing supply of government bonds and newly approved 1 trillion yuan sovereign bond issue created unusual liquidity stress at a time when banks needed to square their books to meet month-end regulatory requirements. A trader said a large number of fund houses, brokerages and trust firms were scrambling to borrow money in the afternoon trade on Tuesday the 31st to avoid defaults as big banks appeared reluctant to lend. Demand for cash far exceeded supply, boosting short-term rates. And there was also speculation that the Chinese authorities wanted to keep yuan liquidity tight to stem the currency's slide against the US dollar in the foreign exchange markets. So what's the summary and conclusion today? Well, I wanted to post this video firstly to share with you the latest data. And just on that point, whenever I do a video like this, I quite often get a lot of comments from people saying, we've seen this video before, you've already shown us these graphs, why do you keep showing us the same things? And the reason that I'm doing that is because this is how monthly reporting works. You get the same data, but obviously it changes depending on what's happened in that particular month. So these videos are basically a monthly update of what's happening in the Chinese economy. And yes, we will be using the same data because that's the data that's released by the Chinese authorities, and we're comparing like for like. When you're looking at something on a 12-month rolling basis, it gives you a very good steer as to what's happening in that economy, because if the trend is up, then obviously the economy tends to be improving. If the trend is down, that tells us that there are causes for concern. And what we've seen in today's video is that exports have fallen year on year by 6.4%. And this was a surprise to the markets, who were hoping that there was going to be an upsurge in the Chinese economy at the end of 2023. And the reason that these figures are so important is that exports make up around 25% of China's GDP. It's a manufacturing economy. So when its exports are down, that tells us that there are major problems, because many of the companies in China who are manufacturing huge volumes of products to be sold all around the world have now seen a 6.4% fall in those exports. And this is coming at a time when factory gate prices have fallen by 2.5% year on year, which sounds incredible. We've been talking about high levels of inflation for the last 2 years, people not being able to afford to buy enough food and the price of everything rising. But in China, it's the opposite situation. Chinese businesses are selling their finished goods today for less than they were this time last year. And that obviously isn't great business, because when you're building your business, when you're working out your costs for the next 12 months, generally you will include some element of increase. And that could be an increase in raw material prices or fuel prices or wages or the cost of your buildings, all of the different factors that contribute to running a business. So Chinese businesses have geared up for growth. What they are very unlikely to have done is planned for falling prices, because that's not the way business generally operates. And this will cause a major problem for these companies, because they'll now have a black hole in their accounts, because their income will be down, but it's likely that their costs will be up. So that means that their profit will be falling. And as we discussed earlier in the video, that means that those companies will pay less tax, will therefore contribute less to the Chinese economy. And overall, this will lead to a contraction in the Chinese economy. And it's interesting that the IMF recently upgraded their forecasts for 2023 for China. They're now expecting Chinese growth to come in at 5.4%, which does seem quite aggressive given the data that's just been released. But the IMF tends to work a month or two behind the actual data, so they may well adjust that again, who knows. But what they have said is that they've now downgraded the expectations for 2024 because of what's happening in the Chinese economy and the ongoing problems with the property sector. And that sentiment is certainly showing through in terms of the data that we've got from the purchasing managers for October, who've recorded an index score of 49.5, which tells us that the majority of companies in China are currently contracting their businesses. So they're not gearing up for growth. They're not expecting a big push for the end of this year. They're actually contracting. So the overall summary of the data that we've received from October is that exports, which are by far the biggest indicator, are down year on year. Imports have gone up, which indicates that there is a possibility that China could be recovering, but the Purchasing Managers Index certainly doesn't back that up. But when you look at what's happening with inflation and factory gate prices, and also the Chinese yuan, there is real pressure on China right now. And even if it does hit its 5% GDP growth target for 2023, it's likely that there will be a slowdown in 2024. And that's obviously bad news for the Chinese economy, but it's also bad news for the global economy because China is the second largest economy in the world. So when we see a contraction in its economy, it definitely has a knock-on impact. So the overall summary of today's video is that the outlook for China remains uncertain. The outlook for 2024 is possibly negative compared to what they've achieved this year, and that means there will be a knock-on negative impact to the global economy, and so there remains a question mark as to what growth is going to be achieved globally over the next 6 to 12 months. So hopefully you've enjoyed today's episode, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.